Hello and welcome to the Weekly Forex Outlook at xm.com. Next week, a great deal of U.S. data will be coming out, including the ISM PMIs, the ADP employment report, and PCE inflation figures. How will all this data impact the odds of a December Fed rate cut and the markets more broadly? I'm Maria Bashir, and joining me to discuss all this is lead market analyst Rafi Boyadjian. So Rafi, can you tell us about the state of the U.S. economy at the moment and why there has been a drastic change recently in the odds of a December Fed rate cut?
Hi Maria, yes, indeed. We've had quite a dramatic turnaround in terms of Fed rate cut expectations. They had actually fallen to around 25% at one point, but in recent days, we've seen those expectations shoot up to 80%. I think most investors are expecting a rate cut at the December meeting. However, it's difficult to say that it's a done deal just yet, because there are quite a lot of hawks within the Fed. There's this basically same old argument in terms of should you prioritize inflation or should you prioritize the labor market? And this is difficult for the Fed, which has a dual mandate. Up until recently, although we had seen some weakness in the jobs market, there wasn't anything too worrying, but more recently, we've seen some more concrete signs of weakness. We had, of course, the September jobs report, which showed the unemployment rate rise to 4.4%. And we're seeing inflation, although not quite necessarily falling, but at least it's not climbing any higher. So I think, although most probably we're going to get a rate cut in December, it's not a done deal. And there's plenty of data ahead of that, which could yet shape expectations.
Right, so we'll get the ISM manufacturing PMI first on Monday, followed a few days later by the services PMI. And on Wednesday, we'll get the ADP employment report. And on Friday, the PCE inflation and personal consumption indicators for September. What can we expect from all this data, and how is it likely to impact the Fed's next move, the dollar and Wall Street?
So we are now entering the blackout period for the Fed ahead of the December 10 policy decision. So I think the data is going to be very closely watched, even though we're not going to be getting the November jobs report next week. That's coming out on December 16th. And although we're going to be getting the PCE inflation data, that's going to be for September, not for October. So now that we still have these delays in the data, I think the ISM PMIs are going to be quite crucial, particularly their prices and employment sub-indices. We had seen pretty decent services PMI in October. I think should we get another decent read, that might dampen rate cut expectations somewhat, especially as within the services sector, we're still seeing a lot of price pressures, which isn't the case in the manufacturing sector. And this kind of casts doubt on the claim that tariffs are to blame for the current sticky inflation situation in the US. Most likely, it's the fact that we still have domestic-driven price pressures, and when it comes to tariffs, manufacturers are actually absorbing most of the higher costs. So I think we're likely to see decent reaction in the US dollar to the data, and the risks are symmetrical at this point. So should we get stronger than expected data, we could see rate cut expectations come back down again, and the dollar would strengthen on the back of that, and then of course vice versa. Now the ADP employment, of course, this has been in the headlines a lot lately because we haven't been getting the official payrolls data. Back in October, we did see actually surprisingly solid data of 42,000 jobs being added in the US economy. Should we get another positive print, I think that would again probably dampen rate cut expectations somewhat. But should we get a negative number, I think that would pretty much lead investors to potentially fully price in a rate cut in December, and that would of course be negative for the dollar, but not so much for Wall Street. I think Wall Street has been benefiting from this reduced rate cut expectations. Now for the PCE inflation data that's coming out at the end of the week, I think personal consumption numbers will be quite crucial to get a clearer idea, even though it's kind of going to be outdated, but nevertheless, to give us some idea of how well consumption is holding up in the US. But as far as the core PCE price index, that's expected to remain unchanged at 2.9%. The Fed has its own kind of forecasting model, so they're probably watching those. So on the whole, though, even though we're still not going to be getting the crucial jobs and CPI releases just yet, I think these data will matter enough, and we could see the dollar respond accordingly.
Turning to data outside the US now, we'll get GDP figures out of Australia, jobs data out of Canada, and Eurozone CPI. What should traders watch out for?
So these are important data, but I think in the current situation for each of these currencies, for each of these central banks, we're probably not going to see a huge reaction this time around. Now, when it comes to the Eurozone inflation numbers, for example, inflation has been pretty steady for at least the past 6 months. It's been hovering around the ECB's 2% target. ECB has been very clearly communicating its stance that it's got no intention of changing monetary policy anytime soon. We're likely going to see flash CPI, the headline figure, remain unchanged at 2.1%. So probably we're not going to see much reaction in the euro. Now for the Australian dollar, we had some pretty significant inflation data recently. We saw the monthly measure unexpectedly jump to 3.8%, and this pretty much wiped out any expectations of further rate cuts by the RBA anytime soon. So the GDP numbers, which are somewhat backward looking, I don't think it's going to have a huge impact, even if you were to see some weakness, unexpected weakness from Australian growth numbers. I think Aussie was probably going to be paying more attention to global risk sentiment. And for the Canadian dollar, again, the Bank of Canada has been quite clear that it's probably going to stay on hold for the time being. We are seeing some signs of recovery in the jobs market, and should we see employment rise for the third consecutive month in November, I think that's going to reinforce the BOC's neutral stance, and we could probably see the loonie maybe slightly gaining on the back of that. And should we see any negative numbers, unless we get a very poor jobs report out of Canada, I don't think we're going to see a huge reaction in the Canadian currency.
Rafi, thanks so much. This was the Weekly Forex Outlook here at XM.com.